What were some of the challenges that you faced, then you found strength again to continue?
There would be these times when we couldn't make salaries. So you'd almost like you'd call up this customer in the middle of the night in the US and you're doing a project for them and saying, can you advance me this month?
What are some of the other macro trends that one should pay attention to?
Let me give you this weirdest analogy. The momentum portfolio gave me an idea that the defense players were moving. I didn't know that. So I was like, oh, okay, so they're buying a lot of defense, let's go check out what defense is and then let's buy it. So you buy after even the momentum guys buys it, and we're not buying at the bottom. But it's okay because as long as you make good returns, how does it matter?
After so many years and decades of investing, what are the 3 investing principles that you've imbibed?
The first thing that I've learned is how many times in your life when you wrote an exam from the time you were a kid, have you failed?
Never failed in
You've never failed. Most of us have never failed.
Yeah.
We've never failed. We've just maybe we've got some few marks less.
Yeah.
Just never failed. And the stock markets are about failure every day.
Welcome everyone to the India Opportunity Show. I'm thrilled to have with me today Deepak Shenoy, who is the founder and CEO of CapitalMind. What started out just as a content blog has now evolved into a comprehensive investment asset management fund and manages thousands of crores as assets under management. He spoke about how the founder's journey evolves over a period of time and how he personally grew as a founder, and it will really benefit all the founders watching today. In our conversation today, we dive deep into different things such as macro trends, what you should be paying attention to if you're building a portfolio in your 20s and 30s, what are some of the things that people get wrong in the markets often, and also how to evolve in your journey as a founder for all the founders watching. Hope you enjoy today's episode as much as I enjoyed recording it. Hi Deepak, welcome to the show. I'm so thrilled to have you here with me.
Thanks so much, Shashi. Looking forward. It's first time for you to in Bangalore to record a podcast. So happy to be there.
You'll always be my first guest in Bangalore.
Yes, there you go.
So, Deepak, I'm very inspired by how CapitalMind's journey has evolved over a period of time. What started by just a blog, as people would have called it back then, has now become a complete research-driven investment management fund. And you also got a license to roll out your mutual fund recently. But after so many years and decades of investing, what are the 3 investing principles that you've imbibed?
You know, it's very interesting that because in the end, investing is a very simple thing. The first thing that I've learned is that discipline works. That means if you think about something in a very structured way, you should be willing to live with that discipline for a strategy that you've built. That means your biggest thing is if you have a disciplined way to look at something, whether you're looking at ROE or ROECE or like me, my fundamental thought process is that prices tell you a lot about stocks, right? So I like to follow the price. So if I like a company, I need its price to be going up.
Price and not valuation? Do you pay attention to valuations as well?
Valuations are the reasons you like it. So you may like it because its value, its valuation is good, and how you value a company is also about how you might perceive its reality. So, for instance, you might say, "Listen, this is a small company in this space, but it's going to grow to this company." Or you might say that, you know what, it's going down, it's going out of a rut. And that rut is because of its past debt, but the past debt is gone now. So, you know what? It's got the potential to become a big company. So, you're thinking its value now because its price to that value is kind of determined. In many cases, you might say, listen, I don't care about the price to its current earnings. I care about the fact that its earnings will grow tremendously in the future. And then I can buy it. Even if I'm overpaying from a traditional valuation metric, I think long term its valuation will be. So, you value a company based on these things.
Yeah.
But the real feedback you get sometimes is the price itself. The price is moving up, and then so more people are recognizing that value. So I like that. But whatever it is, you find certain things that you value. Like for instance, it may be that I like the promote. I have these 4 or 5 factors why I like a business. It may be because I've met the management, I've seen the promoters, I've done a little bit of research on the company. I think this is fitting into my value prop kind of for this thing. Some people, for instance, invest only in pharma stocks or mostly in pharma stocks because they understand the pharma space. Whatever it is, that discipline is your guiding light. So you have discipline, you should be willing to stick with it. And now I'm going to tell you the second role, which is the exact opposite of it, which is you have to know when either you have to break the rules or the rules are being broken for you, which means that you thought of X and suddenly that X is not happening. That X is not happening is the feedback that the market is giving you either by price or because the earnings is not moving the way you thought it will move. Because you thought the earnings will go up and the earnings are not going up or blah. So your ability to take feedback from that market and change yourself is, I think, the second most important thing. Um, uh, I would call this humility, because you need to be humble enough to understand that the market has changed. You are wrong, and most of us have this problem. How many times Srishti, in your life, when you wrote an exam from the time you were a kid, have you failed? Let me ask you
Never
this.
failed in
You've never failed. Most of us, English-speaking population and all that stuff, have never failed until we've passed our graduation and all.
Yeah.
We've never failed. We've just maybe we've got some few marks less.
Yeah.
Just never failed. And the stock markets are about failure every day.
Every day. Yeah.
So you make one investment, you think it will go up, it goes down. And you're like, yaar, what? I was so smart, intelligent, I got my degree, I have these, how can I fail? But it doesn't matter because it's not a theory exam, it's practice, right?
The market doesn't care.
Market doesn't care. And if you're a sportsman, you know this.
Yeah.
If you're a sportsman, you know that, I could go and do the absolute best I could, but somebody is better than me.
Yeah.
Right. And there is possibly at some level, the skills are different. And it's the time of day, it's the heat, it's so many things that can affect your life. And you may not be the best at that sport. It's just people naturally accept failure if you're a sports person. But if you're an academic person, you don't accept failure. Yeah. So if you come from an academic lifestyle into markets, this discipline is easy. But this accepting market failure is not. So I'm telling you that's the next big thing, that you have to accept that the markets will humiliate you and make you humble at times when. So therefore, having extreme conviction is sometimes a bad thing. You should. A friend told me this. There's a saying that angels can fly because they take themselves lightly, and that's how you should take yourself in the market. And the third thing that I would say is, it's an emotional thing as well. And unfortunately, all of markets is about emotion. It's not about that next big idea. It's about handling your emotion.
Hidden fear mostly.
Yeah. So I think the idea is that you should never try to take revenge on the markets, which means I lost money in this stock. So what will happen is you'll buy a stock. It'll go up. You'll be very happy. And it'll go down. Then you will be like, I could have sold it when it was up. No, I was stupid. But then it keeps going down. So you buy some more, thinking, maybe it's a good company, it'll go back up. Then it falls even more. Then you say, I'm sick of this company, it's a waste of what. You sell it. And then it starts going up again. And then you kind of like, nay, I will not buy this stock because I bought it and it gave me this miserable feeling. And then the stock really starts to do well and does all the things that you originally thought it will do. Yeah. And it's going up and you're not in it anymore. Then you buy it again. But by this time, again, you reach this. So your problem is you're becoming personal with the stocks that you own.
Yeah.
You have to understand that stocks are not relationships. They don't love you back. They have no reason to love you back. So it's a one-sided love affair or a hate affair.
Yeah.
They have absolutely no idea of your existence. So you should treat them like that. It's like buying potatoes. The statement in Sholay was, that ghoda घास से दोस्ती करेगा तो खाएगा क्या?
Yeah.
That's the story. That's the point. You're not friends with your stocks. You don't care. This is another reason why I have this rule of I don't necessarily meet the management of the companies that I invest in. Because I don't want to know them.
Then how do you know if it's a good management or bad management? It reflects in the numbers. It
reflects in the numbers. You can see their interviews. You can get their body language, their thought processes. When I meet people personally, I get naturally biased towards, and most people who are running public companies are very suave, very sophisticated. They're very good because they've been successful at running these businesses. So it's not like you will get charmed by them for sure.
Yeah.
And when you get charmed by them, you will not be able to understand why or when they're going, when they've gone off track. and you'll kind of give them a chance, saying, I know him. He's a good guy. He will figure it out. Once you've started to say that, you better hope that your analysis and your judgment of people is right, because the stock market is telling you something else, and you're not able to take that feedback into the price. So this concept of revenge trading, this concept of getting attached to your stocks, this is the worst thing that you can do in your
How
life.
does one come out of it? Because it's so hard to actually put it in practice when you're seeing your portfolio grow down. And it's happened to all of us in the last few weeks, like 20%, 10-20% correction, not 30-40% yet, but, it's still a decent correction. So it's really hard to put it in practice when it's happening. So,
In fact, one of the best ways to do it is to diversify. You have a lot of stocks. You say, "Hey, boss, some stocks, I don't know, they'll go down. It's fine." So Peter Lynch used to have this saying of, you should never get rid of the stocks that are doing well and then add more money to the stocks that are not doing well, because that's the equivalent of watering the weeds and cutting off the flowers. Because I think that is a saying that you say, but I even say this another way: you can keep your losers forever as long as you don't sell off your winners too early.
yeah.
Because a stock that can go up 100% can go up 500%. And if you book your profits at 100%, thinking it's too overvalued for no other reason than it is too overvalued, you might lose that rest of the journey. In fact, last 2 years, I have actually done this on Twitter. So there was a stock I bought at about 900 rupees, which was in the part of the PMS portfolio. And then it went up to about 4,500, which is where I thought it should go. But when I said it will go there, it should have done certain things fundamentally, which it had not done. The earnings had not grown at all meaningfully, and the stock was already at 4,500. And then I said, well, it's reached here. And then somebody on Twitter asked, what are you going to do now? I said, I don't know. I'm not selling. He's like, why? He said, if it falls 20%, I'll sell. It's like a stop loss of sorts. I'm like, he's like, but you could sell now and not lose 20%.
Yeah.
He said, but I don't know 20% from where.
Yeah.
And he was like, I don't get it. And then I said, wait. And then 2-3 months later, it was at 7,000 bucks.
Wow.
And then I was like, okay, it's 4,500 to 7,000. So then I wrote it again and said, no, here it is. It's much more than what I thought it is. We have a reasonably large position in the stock. We've booked some, to adjust so that it's not too big a part of my portfolio. But by and large, we still had a position in the stock. And then the same guy is like, dude, I told you could have sold, but if I had sold it at 4,500, I would not have seen 7,000. Right?
And that would have hurt more, no?
Yes.
Psychologically.
Psychologically. So then he was like, well, I see your point, but you could still sell it and make the 7,000. I said, but because I don't know, that stock went to 16,000.
Oh my God.
And I eventually sold it at about 12.5 or 13,000. It's still at 12,000. But interestingly, every part of this time along the way, I was saying it's 9,000, it's 10,000. People would say, why don't you sell it? Because you think it's overvalued. I said, that's precisely why I don't want to sell it. Because I think it's overvalued. The market doesn't. And when the market tells me it's overvalued, it may be fallen 25%. That's when I'll sell it.
So you would wait for it to fall down
25, 30%. I was willing to give the stock even 40%.
Wow.
Because I was like, okay, it's going to go where it has to go. So eventually it fell from 16 to 12. That's a 25% to 30% fall. And that's when I kind of.
So you were chasing momentum in some ways.
It's always going to be, everybody wants a bit of momentum in their lives. We like momentum. It's it's an underlying. And by the way, this is my feature. So what I've talked to you about is the 3 behavioral things. What I like is momentum. I like price momentum simply because I think that is what makes stocks eventually make money. Where you buy a value stock or a growth stock, eventually you need momentum in the stock price, because that's how it's going to make money in the long run. I focus on it because I think on the other way, it's like if a stock is good, it does have price momentum.
Yeah.
If a stock is bad, it may have price momentum. So it's your ability to discern between the two. So some people say, I know that this is a waste of a stock. I'm not going to buy it despite it having price momentum. Right? That's an interesting way to put it. I say that if I buy a lot of stocks which have price momentum, I know some of them will not be great stocks, so they will lose price momentum.
Yeah.
And I'll walk away. So the things that I care about is, are you liquid enough for me to get out? Are you not doing obvious frauds? in the marketplace. So certain things, are you an upper circuit, lower circuit kind of a stock? Those are things that matter to me more. But otherwise, we all like momentum.
Yeah.
So if you're
How much weightage would you give to this price momentum in your portfolio?
if you gave me two stocks, one with price momentum and one without, I'd buy the one with price momentum any day. I might choose to buy. It's an important factor in my selection of when to buy the stock. So I might analyze a stock and say this is great, but I want to buy it after it has price momentum.
Let's take an example in this, because an example that stands out, because I had a conversation with Mr. Ramesh Damani also recently, and he was telling me of about the defense sector, because he was very early in the defense space recently, and he's invested in a bunch of companies there. But at that point when he invested, the whole entire defense sector was, I think, around $1 billion or so, and his thing was that how can the country's defense sector be just $1 billion? It has to be worth more. So, but at that point, there was no price momentum. Price momentum came into those stocks very recently, and now the defense companies are just running like crazy, and that's a space that you're also interested in. So, at what point would you have wanted to
So
participate?
it was interesting because we actually got in after the price momentum started. So maybe in 2022,
Okay.
switched over from after the Ukraine war. Because what happened was a fundamental change. And that was the reason why the sector suddenly became interesting to me.
Okay.
And you know what? We have two portfolios. One is a momentum portfolio, one is another portfolio called Surge India. Momentum is managed by somebody else, Anup. And Anup started to buy HAL and all that stuff because it was showing price momentum. And then I went in and said, why is there price momentum in defense stocks? So India fundamentally changed. So what happened? And by the way, most of these things are evident in hindsight.
Yeah.
So when we started doing the research, prices were already starting to go up. So I was not at the bottom. I was, momentum, our portfolio in momentum started buying these stocks. And then I started buying them in Surge India. That's because I was looking at this and saying, what has changed? So one of the things that changed was that after the Ukraine war, America froze Russian US dollar reserves. So did Europe.
Yeah.
So I was like, wait, they can freeze your reserves just for that? Then I realized something, that the world suddenly had changed, because they said, wait, if they can freeze your reserves, then if you're importing defense equipment from them, they can freeze that as well.
Yeah.
An F-35, and even now, requires a key every single day for you to switch on the ignition. If you have a fighter plane that requires a US-based key for you to operate, you don't have a plane.
Yeah.
You've rented it doesn't matter how many millions you paid. You've rented it from somebody who, if he doesn't like you, can deny you that key at any given point in time. Yeah. So if that is the case, then India is going to just switch to saying, do its own security. And guess what? The defense establishment itself had a fantastic series of junkets and all that stuff, which was, I buy foreign equipment so I can go to Italy and this thing and all that, and we can buy that stuff. But if we start manufacturing stuff here, the corruption was more easy to detect and determine. So it was never a concern, because corruption was more and more widespread. The defense establishment, on the other hand, was like, we don't get great equipment in India. Yeah. So why should I buy Indian stuff? But then at some point in this Ukraine war, people started saying, listen, we can't buy foreign stuff because, boss, they can stop your equipment. Even if they're better quality, you have to hone the local players. And that local player, that change is what I think drove a lot of companies, because the budget is about, say, 4.5 to 5 lakh crores. Out of 1.5 lakh crores is capex. Yeah. These companies together, other than BEL, if you quote BEL, all of these companies were 10,000, 30,000, 20,000 crore type market caps. BEL was 100,000 crores. So it was like, how can all of this market cap be or just 100,000 crores when the annual revenue of these companies itself could be 100,000 crores? So, and you did a little bit of research, you said, boss, this is a 5x, 10x kind of a scale. So there was a company called Masgaon Dock. We owned it, bought it at like $800. It went to 4,000. Now, I mean, that it's given a 1:1 split. So the price is 2,000 now, but it's equivalent to 4,000. There's a 5x return in 2 years, which is not too bad. Of course, I didn't expect 5x return. I was like, this is a good company, we'll buy it, So the momentum portfolio gave me an idea that the defense players were moving. I didn't know that. So I was like, oh, okay, so buying a lot of defense, let's go check out what defense is and then let's buy it. So you buy after even the momentum guys buys it, and we're not buying at the bottom. but it's okay because as long as you make good returns,
Yeah.
how does it matter if you bought at the bottom or at a higher price?
Yeah, absolutely. And considering, because you said that these things can be only known in hindsight, what are some of the other macro trends that one should pay attention to? Like, in this case, the war was evident in front of everyone. It was happening. It was all over the news. So a lot of people could have trained their mind to find these kind of insights, but, you can only know these things in hindsight, right? So, but is there a way that you can train your mind to be able
To learn about trends, yes, of
Yes.
course. I think we are seeing this right now. For instance, when did Nokia vanish? If you're like, Nokia was the biggest thing when I
Yeah,
was a kid,
of course.
okay? Or, well, I was not a kid, I was 30.
I grew up playing the snake game.
Snake game, yeah.
Yeah.
So you can't pinpoint when, but
Yeah.
it went.
Yeah.
It suddenly got replaced by iPhone and Android.
Blackberries. for-
Blackberry.
Yeah.
There's somewhere in the middle. So, and when did Blackberry go? I don't know. I mean, just like, but then these things started, the trend changes started. What happened was, let me give you this weirdest analogy. And we bought a company based on this trend 2 years ago. Used to have cassettes,
Yeah.
CDs. That was where music was stored, right? So you have to buy a song, you have to buy a CD. The guy who made the song got paid by when you bought a CD. So you bought a CD, I bought a CD. I could copy that CD and you would not make it. The
Yeah.
singer would not make any money, right? Singer and the music company were all making money at a one time. So they would get a song, the song would get released. Anytime the tape would be purchased, there were some small external elements, like if I played the song in say in a restaurant, or not in a restaurant, but in an airport, or at a show, there would be a small royalty that would be paid every time the song was played. So they'd say, give me the rights of this song so that I could play it in a TV show, in a this and that. And that was small. The internet changed something dramatically. What it did was it moved everybody from saying I have to store those songs, have those songs in a CD, to saying I don't need those songs anymore. Once Geo came in and once the internet got
Yeah.
really fast on your mobile, you just start
Streaming.
streaming everything.
Yeah.
So guess how people who are music companies start getting paid now? Every time you stream and play a song,
Yeah.
they get paid.
T-Series, in fact, is the highest watched YouTube channel.
Yes,
Yeah,
but
across
guess
the world.
two others who are next in the list. There's a song
Cocomelon?
called Saregama.
Oh,
which
yeah,
is,
yeah, of course.
a listed company, and Tips Industries,
Right.
which is also a listed company.
Yeah.
So interestingly, these two companies saw a massive change in their revenue characteristic, because now they're getting paid every time you play a song, and you refuse to download the song and keep it.
Yeah.
As in, you don't. So everything is a Ghana, Spotify,
Yeah.
or this. So you're playing it on demand. And I mean, my kids don't have no idea what a CD, this thing. They have no concept of stored music.
Yeah.
Everything is streamed and available on demand. So this change has happened in the last 7 years.
Yeah.
And if I told you this, that even 3 years ago you could have recognized that this trend was happening. You could go to YouTube, see the channel lists of all the Indian music
Yeah.
players, and you could literally see how traffic was increasing, or number of plays, number of subscribers
Yeah.
was changing on a monthly basis. And that was a trend that you could see in front of your eyes. And I think these trends are visible to us as we go along. We just appreciate them more in hindsight.
Right.
Oh, really? This is what's happened. But it happened, in the last 3 or 4 years, and that's how they changed. Whether you're able to bet on the right player or not, I don't know whether you can, because sometimes you have to bet on a lot of players, saying, if India is going to manufacture drugs like crazy, as in medical drugs, medicines, and all that for like crazy, then we can bet on a few players, but we don't know whether we should bet on Sun Pharma or this or that. Maybe
So
you should bet on all of them.
4-5 of them
Yes.
in the
And then
sector.
you just bet more and more on players that do well.
Yeah.
Right? So it's like I bet on 10, but then these 3 have done well. Let me just put more money into those so I can add to my winners. So in that sense, I'm participating in momentum on something that I think will do well in the future. I think these trends, recognizing them is just a part of business. The problem is you have to dumb it down.
Yeah.
It has to become, because we're all sophisticated. We like sophistication. ये AI अच्छा करेगा. The AI अच्छा करेगा, but the players may not make money. Like aeroplanes,
Yeah.
we've had so many companies, listed companies, go bankrupt. Jet
Yeah.
Airways and Kingfisher and all of them. Great companies by their own things, but just horribly managed
Yeah.
from a financial perspective.
I think Richard Branson famously says that how do you become a millionaire from having an airline? Start with $1 billion.
$1 billion in starting an airline. Yeah, I mean,
Yeah.
it's absolutely true. And in fact, this is one of those places where the industry can make money, but none of the players do. It was there in telecom as well. For the longest time, nobody made money in telecom, and suddenly you have only two winners standing are, Bharti and Reliance, and they're kind of making money. But it is also that's also to your detriment, right? You might have thought telecom will do really well, invested money in these players, and then everybody's lost money. So it's like, oh, okay, it's taken you this long to make. PSU banks, banking could make money. PSU banks are the biggest banks in India, yet none of them made any money till last year or something like that. So you could be wrong in this trend analysis as well. So you have to have this idea that you have to bet on multiple trends. And
What are some of the trends that you're paying attention to?
So we're like defense. I mean, I talk about Indian industrialization, and I bet on this 2 or 3 years ago, saying with defense, we'll bet on domestic manufacturing. Because our economy by itself, the Make in India, the concept and all that stuff is to make for India. We buy a lot of stuff from, import a lot of things from the US and not from the US, but from a bunch of countries. China is the biggest.
Yeah.
Now, one of the problems with this is that at some point we'll be like, people will manufacture for the world, but doesn't get customized to the Indian, kind of psyche and all that stuff. And stuff that we really want, we will start making here. And biggest things over that as railways, defense, where there's also a strategic nature of wanting to, have more domestic manufacturers, but also in other places like cars. We'll want more domestic manufacturing. We want a local domestic car industry because the domestic car industry adds layer of security as well. Saying that if we're at war with some country, they're not going to stop our complete transportation.
Yeah, like today I came in a BYD car and I was wondering when is India's revolution going to start. But I think we are
EV is coming,
see.
and we are actually preventing Chinese cars from coming so that we can have Indian cars kind of come to a competitive level. Maybe that's not always the best thing to do, but I think that is the governmental focus. Is like we need to get more independent in our manufacturing. We've never been able to do that, and maybe going forward we will.
And rightly so, right? Like if our goals are so ambitious, like $40 trillion and what all, then we have to start doing
that. Yes, and to be honest, we've given up. For instance, the biggest two UPI players are Google Pay and PhonePe, both not owned by. I mean, of course, PhonePe may list and change that game, but that is something that you've kind of ceded some part of the game to. Of course, now, but there was also Paytm, but Paytm is now listed, and that's Indian as from where it goes. So I think that's domestic, and a lot of domestic players I think will eventually come up and start to take precision in that space. Now we use Twitter, we use YouTube, but these are platforms that have no Indian ownership. At some point, we want even some Indian-owned platforms to make money, but I think that will also come. It will also come over time if we produce the kind of players that can be fairly large. We'll find the Indian players also start to make a dent in this space, but it's not yet happened. It's early stages for that. But I think that part will definitely happen in the Indian goods manufacturing place, physical goods manufacturing spaces. It will happen. That is one layer. And then we have the whole concept of financialization. India is moving away from real estate and gold and moving very quickly into financial assets like mutual funds and stocks and insurance and all that. So a lot of players here are relatively nascent in comparison. To give you an idea, India's entire market today probably trades as much as 2 stocks in the US trade per day.
Yeah. Like we make up 3.5% of global equities roughly.
And 2 or 3 US stocks are equal to the entire Indian market cap. So to that extent, we're small. So we
Yeah,
will
market cap wise, we don't really have the companies like in the US. Like, in fact, in the private space, there's a trend where, earlier investors would ask their companies to go and list or register in the US. Now the trend is flipped because they want to see an Indian listing happen instead of the US listing.
That's because India is willing to pay premium
Yeah.
for so more than 400,000 crores of new money comes into stock markets every year.
Yeah.
The number of new listings every year, including current companies that are raising more money, is 200,000 crores. So obviously, more money is coming in than it is being demanded.
Yeah.
You're going to just find that companies get more expensive.
Yeah.
So you need more companies to list and more good companies to list in order for the market to kind of absorb these flows. Right now, what's happening is this is being absorbed by the fact that foreign investors are selling and taking their money out.
Yeah.
But
I
when
think there's so much talk around that. Okay, let's talk about that aspect also because, every day if you switch on the TV, everyone's only talking about FII inflows and outflows. But I've heard you say that it doesn't really matter because India's domestic markets are deepening to a large extent. So, one aspect is also that, the US is under a lot of debt and, every Ray Dalio and a few other investors talk about how the US can possibly go bankrupt. So, and if the US market gets hit and goes under a recession, then obviously there'll be ripple effects across the globe. So, I think let's dive into that aspect also because that's also a macro trend that we should be paying attention to.
Oh yeah, I mean the US is India is a very interesting sweet spot. We've gone through a lot of the damage that the US is going through right now.
Yeah.
We were over indebted. In fact, our largest expense currently is interest payments on our debt. Second is defense. So, and the defense is like 40% lower. We spend like 9 lakh crores a year on paying interest on our debt. And defense budget is like 5.5, 6 lakh crores. So, it's much lesser. Where most of our taxes go to paying interest. America is now getting to that point where their second largest expense after, I think, defense is interest payments. They have $36 trillion or $40 trillion of debt. That's a lot of money. And basically, when they are coming to a point where the world economy is changing, they are trying to rewrite the lines of this debt thing and try to go into a recession to introduce tariffs and all that stuff. India has done the same thing. We already introduced tariffs.
Yeah.
We're like, boss, we are already ahead of you. We know how it's going to pan out.
Yeah.
Things are going to hurt for a while and then it'll be fine. So, because of that, I think we're much more prepared for what's coming next. We've seen inflation; they are seeing inflation. We are in the process of reducing our inflationary impulses. They are in the process of trying to control it. So we are, in that sense, one step ahead because we've seen these problems in the past. We have seen what happens when you print too much money.
Yeah.
That's why we print less money. America is now suddenly trying to realize, oh, we printed too much, so it's coming. So there is a lot of these aspects which I think they are in the learning process of. But FIs will keep pulling out money for the near future, I think, in general. Until they realize that they need exposure to this country, which is probably the only country growing. And the only reason why it's interesting is because our average age is in the mid-20s. We are going to become in the mid-30s in the next decade.
Yeah.
So by about 10 years, our average age will be 34, 35. 34, 35 is a sweet spot for almost every economy in the world. When they reach the point where their average age was 34, they were booming. Because this is the age when you will earn and you will spend and you will do things, and that makes for a fantastic economy.
I think US, China, Japan all went through these bull cycles.
Yes, and when their average age was 30, in the mid 30s. So in the next 10 years, India is going to reach there. And guess what? If you want to participate in this growing economy, you're going to have to come here.
Yeah.
So eventually the FIs will bring their money back. Regardless of what happens. Of course, there will be drama. They will take the money out.
Yeah.
We will make some changes. We will say, please come back. They will come. So all that stuff will happen. But if you're looking at me, if I'm looking at here is someone in India and looking at the next 10 years, there are only two economies I want to invest in. India for the scale and the growth.
Yeah.
And the US for the innovation.
And not China?
Because China doesn't like foreign investors. So I could invest in their economy. I will make no money because they will arrest the founder and put him in jail. They will suddenly say foreign investors are not allowed. They will put random tax laws because they're not a capitalist economy by definition.
Yeah.
So I would love to be Chinese, but I don't want to invest in China. If you are Chinese, you don't have a problem because the government loves you.
Yeah.
Right. So to that, of course, don't be a founder of a company and go to jail. But beyond that, yes, they love you. But you don't want to be Indian or American or anything else and then invest in China because they will cut you off.
Yeah.
So therefore, the only two countries to invest in are India and the US for the most part. It used to be that Japan was good, but Japan's lost its industrial strength over years. It's gone into a different zone of things. Even Korea, it's cheap. It's ridiculously cheap.
Yeah.
There's hardly much happening out of there. With all their money, they couldn't do anything about this AI revolution and all that stuff. Not that India is, but I'm just saying that in terms of innovation, it's still just China and the US. And the US is the only investable part of that equation. India, I think because of scale, we don't have to innovate that much. We just have to fix small things. I mean, we fix small things like delivery, logistics.
Yeah.
And guess what? We suddenly have a Swiggy and Zomato, which are these huge, huge companies. We have Uber and Ola, and they're all fixing human or transportation or food logistics, right? So to some extent. So we have to fix really simple problems and we'll grow big.
What do you think of some of these new age stocks? Because these tech stocks, it's very similar to what was happening in the 90s in the US, where suddenly now Mag 7 account for 30-40% of their market cap almost. So is that a trend that you see playing out in India as well?
It's always been there. India, the banks used to play a very large role in the overall market cap of the companies. Today, it's Reliance and a bunch of stocks, and Reliance always been one of the top. So it's always been top heavy in that sense. Will tech take over? I think it'll take a long time. These are not really tech companies. I mean, Zomato is not a tech company. It's a logistics company that uses techs. Is the same, I would say, with a lot of others. They're not necessarily tech companies. They have other ways to make money that is beyond the technology, but they use a lot of technology in what they do. I think Bajaj Finance is as much a tech company as Swiggy or Zomato are. To be fair, and just that they call you far more often. But more importantly, I think what we're to understand is we don't have pure tech. We don't respect pure tech as a financial market yet. Maybe we will in the future, and that's when we'll get a lot of tech innovation. That's till then we will not respect it quite as much. This is also the reason why large IT companies, even though with their large balance sheets, haven't invested in pure tech as a concept. So I think we may end up being top heavy anyways because it's the nature of markets. Pareto principle, 20% of the market is 80%, whatever. And the issue is that these companies may not necessarily come from a pure tech background. They may not sell you purely technology, but they will sell you great stuff with technology. The biggest brokers in India are tech brokers. Grow and Zerodha for that matter. The biggest, most of the biggest other players are also going to be using tech. So HDFC Bank is known for its technology. Technically, people don't like it.
Actually, people don't like it.
They like technology in the finance space. So everybody expands using technology. Bajaj Finance uses a lot of technology. A lot of the other players, even M&M in its cars is adding much more technology in its space. People are actually scared of that. They're like, oh, what if this technology breaks down? But by and large, these seem to be very interesting cars. So I think a lot of this is changing, and tomorrow, I think a lot of the newer age players will get into the Nifties and all that stuff and hopefully profitable. The problem is our largest, most profitable tech-based companies are not listing. Zerodha, Zoho, ridiculously profitable.
And they never plan to list either.
I mean, I'm like, hello, please. I mean, we want...
Let us participate.
Give us something, So, I mean, we'd love to pay you brokerage, but we'll also like to buy your stock. It's like, at some point, I think it was George Fernandez, I think, who wanted these foreign companies in India to list, including Coke left India at that time because it refused to list. But some of the others, HLL and few other companies, they chose to list, and Glaxo and bunch of these things. So the idea was that you not only bought their products, but you also participate in their service. I'm not saying you should force companies to list, but I'm saying that over time, the companies in India will naturally list. Like you said, earlier the idea was you build in India but list in the US. Now it is, if you build in India, stay in India. All these people like Pine Labs and a bunch of these PhonePe and all of them are paying ridiculous amounts of tax
Taxes.
to flip their companies back
Yeah.
into India because they got some horrible advice from people who were apparently very
Who
smart.
didn't give you money?
Who told, no, who didn't, yes. But they got that advice to say, go to Delaware and
Yeah.
incorporate there. But guess what
That
Delaware
was
did?
very common advice, by the way, till just 2 years ago.
In fact, if you ask even an Elon Musk, he will say just steer, because when Tesla was listed in Delaware,
Yeah.
they promised him a compensation package that said you will get so much as a percentage of this company if the share price goes here. And he said, I will take zero salary until that time.
Yeah.
And he went in and he did this massive
Yeah.
thing. And then the Delaware court said that is too much compensation.
Yeah.
Like, hello, where America is supposed to be capitalist, not communist.
Yeah.
But apparently this is okay. So this was Delaware. And Delaware is retrograde in that respect. So I would say at this point, even if you want to go and list a company in the US, you don't choose Delaware as a
Yeah.
place to go and list your company. But either ways, it's better to stay here. And we've always been India. We need to be an Indian company because we're regulated in India, and they will not accept if you're gone incorporated in Delaware or something like that.
Yeah. So, as someone who might be in their 20s and 30s looking to build a portfolio, now that we've established that India is the best market to invest in, how should they start?
I think, see, the simplest thing is we are active fund managers. So we choose stocks and all that stuff. So my natural bias is to tell you, buy whatever we make, right? So it's like, come on. But in general, I would say this, forget us. Just do a personal risk analysis of when you need money. And if you don't need money in the next 5 years, that is the kind of money you can keep in equity. So if you say, oh, I need to pay my kids' education fees next year, tell me which stock to buy. I will say there is no stock you should buy.
Yeah.
So you find out what money you don't need for the next 5 years and then put that money into equity. You can put it into Indian equity. And if you don't know what to choose, just choose like index funds. You can use a large cap index fund, a mid cap index fund and so on, and just choose some and go with it. You can build this over time. You can always change it. There's no problem with that. Once you get comfortable, then there's another level. Then you say, oh, I want better than the index. Then maybe there is a set of mutual funds that can do better for you.
Yeah.
Then there's another layer on top, which is the PMS and AIF. Now you have 50 lakhs, 1 crore to invest. You can give parts of your money to such companies. And we are a PMS right now. We applied to become a mutual fund. So then we become those active layers that happen one layer above. Now we've done well. In the last 5 years, we've done fairly well. So to the extent that we've done nearly 2 times what the index returns have been. So you might look at us and say, well, why should I choose in the index? I should choose this you or, choose this mutual fund and so on. I think it's more an evolutionary path. You have to get comfortable and then you have to choose what it is. Don't choose the highest return product in the past because it's
Don't filter it by 3 month or 1 year returns.
I know, yeah, because you'll get disappointed.
Because that's how the app's also structured, no? So
And yeah, I will tell you all these things and it's like people telling you about labor. It just does not happen that people will learn. So you will do all these mistakes, you will learn, and then the only thing you should do is not get out of the game. Which means don't lever yourself, don't borrow money to invest in markets, don't put so much money that you will feel so miserable. There's an uncle point concept. I have talked about this at some point, that if you reach a point where you lose so much money that you can't even live with yourself, and that is the uncle point where you literally call your uncle for help. You're doing yourself a disfavor if you don't know what your uncle point is. And you actually should be at a point where you say, if I lose 30% of this money, I'll walk away. A friend called me recently and said, Deepak, I have some money for 1 year. What can I make out of it? I said, there is no money you can make out of it. Just put it in an FD. So he's like, why? No, but I don't want to lose money, but I don't mind making 0% returns. I said, you don't get that. You want the ups, you have to live with the downs.
Yeah.
Right? If you can't handle the heat, you shouldn't be in the kitchen. They will be negative returns, and at some point it could be minus 30%. Can you take that? He said, but I can't lose 30%. I said, that's precisely. So how much can you lose? He's like, well, okay, I can't lose anything, and that's the point. That's why you should be in an FD. Okay, what if I can lose 10%? So as a market's going to lose 30%. So if you have 100 rupees and you can't lose, you want to lose maximum 10, then don't put more than 30 rupees into the market. That's the way. So you start with that, do this and build your portfolio. I think over a period of time, your index funds will help you build your foundational portfolio. As you get smarter and smarter, you can probably say, okay, I can choose active funds to kind of layer thing above. Lots of these, there's this whole organization that is built by index people who say index funds do better than active funds. But I've gone and shown that there are times when active funds do better. And there are times when we've done this, we've done it for 5 years. But you can't just say that I will do better just because I've done better in the past, right? So all I know is that you have to have a balance.
But you don't see that changing, like, in the US, it's mostly passive investing now compared to active investing. Do you think that will happen for India? Because it's not really taken off in India as such.
Well, it has, to the extent that about 9 lakh crores in passive funds versus 30 lakh crores in active. So it's a reasonable part in the equity portion. But I think overall, passives will do well for people who, for instance, your EPF money today, almost 10% of it is invested in passive funds because they don't know how to select manager. They've said, we don't want to select manager, we'll just select the Nifty 50 and that's it. So they're buying that. So I think passives will do well on their own regard. It's just that I feel there's a lot of active opportunity in India, a huge amount. Because a lot of the mid caps and small caps, they're the ones that will become large caps. So if you identify them early and you're in a growing economy, you're kind of able to do that. In America, what's happening is I think more of the fund flows, half of fund flows are active and half of them are passive. So they've reached that point. But I don't think it'll get much more than that. I don't think we'll ever reach a point where 75-80% of the funds are only going to passive and less of the funds are remaining active, because then there is no incentive to buy any good companies, because if it's only passive, then if it's in the index, it's getting money. If it's not in the index, it's not getting money. So I think India will change more towards passive, and it's possible that passives on average outperform. But today it's not the case. Passives underperform the indexes by a very large amount, sometimes as much as 0.8 to 1% a year.
Oh, okay.
Whereas actives may underperform but by only 0.1% a year on average. But there are enough active funds that have consistently beaten the indexes for years at a time. And that should not exist in a market which is supposed to be, some days you'll beat, some days you won't beat. It's like saying Virat Kohli is somehow always in form. How is that possible? But you also know that even if it's a Virat Kohli, there'll be times when you go out of form and you will switch. There was a time in which Ivan Lendl was the best player, and then Boris Becker, and then somebody else, and then Roger Federer, and then Nadal. And so the leadership changes and you've changed along with it. I used to be a Schumacher fan and a Ferrari fan, and my kids became fans of McLaren, and because they were winning. So it's just different age times, so you just have to switch with those times. So an index gives you the ability to say you're always with the top, right? An active fund that consistently outperforms is also, it's not going to be outperforming every single bit of the time, but by and large, if over a 5 to 10 year period it outperforms, does it really matter? And if it outperforms by 1 or 2% a year, that is fantastic for you. It means it has a meaningfully big return gap between an index and you. So you can choose those active funds maybe a little bit further down. So you're in your 20s, you're choosing the index funds. You reach your 30s, you start getting into the actives. You start choosing what works for you. What my fund is, eventually choose what works for you. If you like this space, then I'm telling you, passive, active, you have enthusiasm, return, I will check which one will be better and all that. All that is fine. But in the end, you're like, boss, I don't understand this money business. Just put half your money in equity index funds, half your money in like a FD and leave it. It's okay. Focus on making money. I think that's the biggest thing you can do in your life. But that's going to change the first 10 years of your life. All this saving stuff is bullshit.
Because there's so much investment advice these days when no one teaches you how to make money.
I mean, just make more money. Just
Yeah.
go do your AI, take an AI course, buy a subscription, invest your money in that. You will make more income doing that than you will buy all this gyan that people like me give all the time. Index fund mein dalo, wo 500 DMA and some. Who cares at this point? At some point, just make more money.
Yeah.
And even if you put it in an FD, you will end up with a much better thing. There will be a time when your corpus becomes so big that becomes 3 or 4 times your annual income. That is the time when you will feel that, oh, now if I invest at a slightly better return, it has a meaningful difference in my life.
Yeah.
It can change me from economy class to business class. If it's not changing you from economy class to business class, it should not worry your life too much. So
I think this entire generation is getting misguided with the FIRE number and the FIRE conversations, because why should you retire? If you find something that you love doing, you should ideally do it for the rest of your life.
most people actually now start to hate doing what they're doing just so that they can say that they want to fire.
Yeah.
So I mean, it's a matter of now principle. It's a religion. If you aren't thinking about fire, are you really like alive or human or whatever? But I'm like, here I'm 50 plus. I've just turned 50. I have more enthu in life than I had when I was even 20, 22. I mean, so honestly, if you took me out of my job today and told me you're not going to work, I would be miserable.
Yeah.
Now, you give me all the money in the world, but I would actually be miserable because you can only holiday that much and party that much and travel that much. I mean, I've traveled, but I mean, after a while, even the travel will like,
Yeah.
I want something to do. I want something to look forward
Something
to.
intellectually
Stimulating. Yeah. And people die in the early 60s, apparently, not because they have lived bad lives, but because they stopped working.
And they lose a sense of purpose.
And then you'll get your heart attacks and this and that stuff simply because you're suddenly so perturbed that you're not doing anything meaningful. And everybody wants to be meaningful, right? I want to do something meaningful in terms of affecting. And I'm telling you, this is a problem not just in people who are retired. Women who have babies in India, because help is so difficult to get or relatively, you give up your careers. And that finding that sense of purpose is so important. And I think we are doing our women a massive disfavor by not addressing this. We need to figure this out because they are intelligent. They're half the workforce. They're far more intelligent than men in many ways. They're far better for money managers, for instance. I think more fund managers should be women than men. But in general, we are missing a trick on the fact that we are making them lose the sense of purpose by isolating them into just family, taking care of, kids.
Just to take my example, 40 days after giving birth, I was like, I need to get back to work. My life just can't be about diapers and feeding and all that, because I love my work. So why wouldn't I want to come back?
Exactly.
But I guess, one has to acknowledge privilege, and you don't have the infrastructure for women to be able to come back to work very easily. So we need to work on that as a country.
To be honest, it's either the poorest people get it because they have to work.
There's no
and
option.
The richest people get it because they have help. It's everywhere in the middle that seems to be like this, oh, I will give up my career to bring up my kids wala thing. And we've kind of glorified that notion also somehow in our culture and all that stuff.
Women are sacrificing. And that's a great...
I mean, like, hello, don't do it. Just don't do it. I mean, get your, I mean, I've been guilty of it as much because I've hardly been around as much as I should have perhaps. But I know that this is real, and me and my wife talk about all the time. It's like, you need that sense of hope. You need it, and it has to come from meaningful work at some point. And if you're out of the workforce for 10 years, you feel like, oh my God, is it ever possible to get back in? And I think we should make it possible to get back in. And I mean, I would love to, kind of get involved in initiatives that will help as much as anything else. But I think this is also a problem with the FIRE movement. Is that if you go into this thing, this retire early is not going to excite you. I think financial independence is an absolute necessity, but not retire early.
Because you've dealt with thousands of clients, what are the 3 biggest mistakes that you've seen people make with their money?
That's a good question. I think the big things that we have is people get too attached to the concept of making money and not spending it. because money's only objective is to be spent.
Yeah.
This concept of, like, for instance, the word generational wealth is specifically designed to say, I want my next generation to be. Kyun? You taught them enough. Let them go make their own money.
Yeah.
You should enjoy your money, go and spend it in some way. We are not responsible for the wealth of our children. We are responsible for our own. And to that extent, I think people have that. The second thing, I think people get attracted to shiny objects like returns of a 1 year, 2 year kind of a time frame. They're not patient enough to hold through the thing. So it's that lack of discipline in that sense, but it's also the lack of patience and the shiny object problem, which we don't have in real estate. So if somebody sells a house in your apartment building for less than they bought it at, that you bought it at, you'll feel miserable for 1 or 2 days, but you don't go and sell your own house, no? But in the market, if the price goes down, you sell it. You're like, nikalo isko, whatever, and all that.
Yeah.
So that, I think that is another problem that we have in terms of patience. The third thing I would say more at a broader level is, I think we don't expand our horizons enough. So we'll invest in India only, but not US or not other countries. We'll invest in the areas which we know, but not diversify beyond. We will not take risks beyond a certain point. So you invest only in large caps, then you watch the mid cap fund go up, things like that. I think to some level we should understand that risk taking is an undeniable nature of our future. We will not get great FD returns for the rest of our lives, and that at some point when we take these risks in our personal careers, sometimes we don't take risks in our personal careers. We take very boring personal careers because we want less risk there. Then you should take some risk in your investing. If you're taking a lot of risk in your personal career and you're a person who's a VC or a family office, you're taking risks in your in your professional part of your life. Maybe you don't need to take as much risk in your personal part of your life. But if you're taking, so if I would say balance out that and take more risk. Too often people are too conservative. The biggest thing, and I come back to that, people don't spend enough. I think that's the problem.
That's when India's economy will truly blossom and consumption becomes.
Forget that. I just think people are just happier if they spend to the extent that they want. And I don't think I should think of this broader, Mother India wala situation. I should think, if you're traveling somewhere, live in the nice places that you want. And I mean, people tell me that, Deepak, what? If you tell people to spend, they'll spend all their money. But I'm like, nee, there has to be a balance. No, I can't tell this fire. It's like, I'll eat noodles.
Yeah. I won't drink coffee. I'll eat noodles.
And I'm like, what are you doing? This is nonsense.
Enjoy your life.
Enjoy your life. Yeah.
You have one life.
People come in their 20s and say, what should I invest in? I'm like, why? Go, enjoy your money. You're too young to start thinking like this.
Very contrary to what we hear
what
otherwise.
Money managers normally say, what's the point of money? For me, money is part of the journey. It is not the destination. I think that's the core of what money is. And when you start treating it like a destination, I feel like a fraud, because my goal is not to make you 75% returns. My goal is to make you live a better life. That should be my goal. If I've made you enough money, then I should be the one telling you, go and spend it. That's what I should be telling you, because you've made enough, and that's what you should be doing.
Thank you so much, Deepak. I think that's a wonderful note to end the episode with. People should enjoy their money, and people should continue to live better lives as they prosper through Indian equities. And I think that's the dream that we're all hoping to inspire people with. So thank you today. Thank you for taking the time out today to be with me here.
Thanks so much, Srishti. And like I say, our mutual fund is going to say it, hopefully, if we get the license, is that our goal is for you to win at life. And that's what I think every one of us should focus on. Just win at life.
That's amazing life philosophy and fund manager philosophy as well. All the best to you, Deepak.
Thanks so much.